Hello, advanced accounting students. The sun is shining, and I'm about to cover Mastery Problem 12-M like I promised. I went ahead and I've already put in dates and check numbers and my cash debits and credits in both of my journals, both the receipts and payments journal, just to try to speed things up a little. So I'm going to go through relatively fast and I'll tell you the calculations that I made for each. So let's start on April 1st. I know that I purchased some bonds, so I am the buyer. So what am I buying? I'm buying investment securities. And it comes down to what is the price of those investment securities that I'm paying. So I'm going to credit cash and debit for that same amount. And it's the 10 bonds that I had times the price it said in the problem on page 363 of 1,008.52. So I just multiply those two to get that. The next entry on April 27th, I'm just making my semi-annual interest payment. So whenever I do that, first thing I compute is the amount of the payment, the cash credit. And to compute that, all I need to do is take the face value of $750,000 times the stated interest rate is 6.5% times 1/2, and I would get $24,375. And then the next thing that I want to do is calculate how much my interest expense was, the debit, because expense is always debited. So the amount of my interest expense is the carrying value of $749,274.31, which they gave you, times the effective interest rate of 6.7% times 1/2, which is $25,100 and 69 cents. And then as the accountant in me, I don't like that my debits don't equal my credits, so I know I need a credit of $725.69. And what that is, if I'm making an interest payment, is definitely a discount on notes payable. And the reason I know that is because discount normally has a debit balance, and when I make the interest payment, I'm amortizing it, reducing it. So to reduce with a credit, it would have had to be a discount initially. The next transaction is probably the easiest one. On May the 1st, we are retiring the bond issue, the entire bond issue. So I do that at face value. I credit cash and pay them the face value, and I debit bonds payable to get rid of the face value of bonds payable because they are officially retired and gone. And as I've stated in other things, there is always a debit or credit to bonds payable at the face amount. You always use the face amount. The next entry is on June 1st, and it says we're receiving cash for bonds, so we are issuing bonds in this transaction. So it told us in the problem that the amount we received was $396,517.20, so I have debited cash for that amount. And then the other things that I know is if I issued them, like I just said, bonds payable is going to get credited for the face amount of the bonds. And that face amount of the bonds is $400,000. So we will credit bonds payable because we always credit when we issue. And then I know that I debited cash for $396,517.20. I credited bonds payable for $400. So the difference to make my debits equal my credits is a debit of $3482.80. And if it is a debit when I issue these things, discounts are debits. Discount on bonds payable. So the next transaction is July the 1st, and we are paying our semi-annual interest payment on the $500,000 bond issue. So again, the first thing I do when I do an interest payment is calculate the cash credit. So I'm back down in the cash payments journal, the cash credit. And for this one, it is the face value of $500,000 times the stated interest rate of 6% times 1/2, and that got me $15,000. And then I said I like to do the interest expense next. And that I'm going to take the carrying value, and the carrying value is 560.51, which it told you in the problem, times 5.9% effective rate times 1/2, and I would get 14,796.04. And to make these equal, I need another debit of 203.96. And I know that is a premium on that bond that I am amortizing. Because when I amortize a premium, it's a debit. So it's normally a credit. When I amortize it, it's a debit. The next transaction on July the 1st is probably the more difficult one that you have to do. So it says we redeemed the bond issue with a call option of 105%. So the call option says that I paid 105% of face value, so 1.05 times 500,000, and that's how I get the cash credit of 525,000. The next thing that I know is that because I've called the bonds, I need to take the bonds off of my records, and that means that I need to debit bonds payable for the face amount as always. I think that's one too many zeros. And then the other two accounts I know I'm going to use here is premium on bonds payable and loss on redemption. And I'll talk through how I come up with that stuff. So first, let's talk about the premium on bonds payable. What I know I'm doing here is I'm saying that this bond issue had an account balance in the premium account, and since the bonds have now been called, we need to get rid of that premium and basically zero it out. So the amount that was in that premium account is the carrying value minus the face value. So the carrying value, this is the tricky part. At January 1st, in the previous transaction, it had told you that the carrying value was 501,560.51. And then in this last transaction, we debited it, the amortization. So if I take 501,560.51 minus 203.96, I would get 501,356.55. That's the carrying value at that point in time. And I subtract the fair value of the bond of 500,000, and I would say that I have a premium balance that I need to amortize, get rid of, whatever word you want to call it, of 1356.55. And I have debits of about 501,000, credit of 525. I need to make that equal. So the redemption of 525 minus the carrying value of 501 is 23,643.45. Okay, so that is the most difficult transaction you're going to have to do. So the last two transactions that we have relate to the bonds we had purchased, the investment security, on the very first transaction. So on October the 1st, we received our semi-annual interest payment. So on October 1st, to record our interest revenue and our cash, what would we want to do? So the first thing, again, that I like to do is I like to get the cash debit. So I would take the face value of the bonds times the stated interest rate of 6.25% times 1/2, and I would get $312.50. So that's the amount of the cash debit. Then I would want to get my interest revenue. And the interest revenue, just like interest expense when I'm on the other side, is taking the carrying value of $10,085.20, which was the amount we had purchased it for, times 6.05%, which is the effective rate that was stated on April 1st, times 1/2, and I would get 305, and I put it in the wrong column, we're on revenue now, 305.08. And the difference between the 305.8 of revenue and the debit on cash is 312.50. Up 312.50 is $7.42, and I need a credit to make those equal. So I will credit investment securities, bringing the value of that down closer to face value than that account. And then on October 1st, we sold the investment in those bonds for $1,025 per bond. So we sold it for $1,025 per bond. So we take the proceeds, which are 10 bonds times 1,025, which is our cash debit of $10,250, and we debit our investment securities, not debit, credit, I keep saying that, for the carrying value of that investment security. And again, that's the kind of tricky part about the whole thing. So let me put the number in first, and then I'll explain it. So to get the carrying value, we take the April 1st carrying value of $10,085.20, and then less this reduction that we just did in the previous transaction when the interest payment was received of $742, and we get $10,077.78. And then we need our debits to equal credits, so we have a gain on sale of investments, and it's $172.22. So that takes care then of the mastery problem. Hopefully that helped a bit. And then the other thing I wanted to let you know is that I'm going to do a few short videos on sections 1, 2, 3, and 4 of the chapter with just some key things, rules, things like that. Justin suggested I try to do that to help you know what you're doing as you're going through some of these. I do know it's complex. I know it's hard. Like I told you, it's the thing that nearly made me fail my CPA exam. But that's why I wanted to give you some extra time with this and do the video. If you have questions, shoot me a reminder or an email, and I'm happy to try to help.